It is still open enrollment, open season. We got Kevin back here to talk about the HSA. We were so fired up about the HSA in our last conversation. So many people are fired up about the HSA. We decided to run it back. Is that fine with you, Kevin?
Oh, no, that's great. I love talking to HSA. It's an awesome benefit.
I mean, it's the only triple tax savings account there is, really. I mean, it's something worth noting. And I will say on a more serious note, very few people understand all of the benefits. So we're going to cover 5 different benefits to the HSA today. We're also going to talk about what it is, just to give you a little bit of a refresher. My name is Michael MacKelvie. I'm a certified financial planner with Mariner Wealth Advisors. I'm joined by Kevin Ahern. We wanted to bring Kevin on here because he's our benefits specialist. This is Mariner Wealth Advisors. This is Your Life Simplified. Kevin, let's just jump right into what is an HSA. Can you break down real quick just what an HSA is?
Yep. An HSA is a health savings account that is paired with a high deductible health plan. So it's an account that allows you to set aside pre-tax dollars to pay for current or even better future healthcare expenses.
Yes. So pre-tax dollars, and here's the triple tax save. So this is benefit number 1. Okay. You put the money into the HSA, you get a tax deduction for that. Okay. So that lowers your taxable income. You can invest those monies, and if those monies grow, hopefully over time, you don't have to pay taxes on that growth when you take the money out. And you can take that money out tax-free if it's for qualified health expenses. So again, triple tax savings, there is no other account that's really comparable in that arena. So I would say that's benefit number 1. Now, benefit number 2, portability. Can you talk through portability really quick?
Yeah, absolutely. So with an HSA account, this is your personal account. So a lot of times employers will have a preferred HSA provider, and they will open up an account on your behalf. And if that's the case, if they make a contribution to that account, which is very, very common, it's still your personal account. They are very hands off from that account. If you change jobs, if you change medical plans, that account goes with you. You can still utilize the funds in that account. So it is completely portable. It is your individual account.
Very important to highlight.
Yeah. And if your employer doesn't have a preferred vendor, you can go find your own HSA provider and open up your own HSA account to make those pre-tax contributions too.
Yes. Again, that's something I think few people know, because not every company has an HSA. So if your company has a high deductible plan, and maybe an HSA is something you've heard about, you're curious about, and you'd like to take advantage of it, I would encourage you to, if you have a high deductible plan, you can go open up one on your own, fund it, and use those monies accordingly, right? So definitely something important to highlight there. And then again, if you leave your company, which chances are you probably will, given today's current climate, at some point in time, you can roll those monies over, not only to the next year and continue to use them for years going forward, but maybe to the new company HSA plan or to your own HSA that maybe you're self-managing. So benefit number 3 here, Medicare premiums. So at some point in time, you can actually, you will actually have to pay Medicare premiums, likely that is. If you make it to that point in time, we'll see what the future holds. But currently, you can use part of your HSA monies to pay for Medicare premiums. A lot of people don't know that they have to pay for Medicare. It's income-based, whether or not you will have to. But many people do end up having to pay for Medicare, and you can make those payments via your HSA. So again, there's going to be likely some reason as to why you'll need this HSA at some point in time down the road. That would be a tax-free distribution if you used it for Medicare premiums. And again, that's income-based, but an important note there. The next benefit I think that's worth noting here, you have investment control. Okay. My phone goes off for this podcast. You have investment control. So you can invest the monies accordingly based on whatever your goals might be. So personally for myself, I'm looking at these monies that are in my HSA, and I am very much growth oriented as far as the monies that I have in my HSA. I'm thinking, hey, down the road, I'll probably need these monies for some long-term care health expense, whatever that might be. I want to get the best tax benefit out of these monies. So I invest them from a growth standpoint. Now, if you're maybe 10, 15, 20 years away, you might have a little bit different investment horizon. But again, one of the benefits here is the investment control that you have. And I think a lot of people don't know that they can invest the monies within their HSA. Would you agree?
100%, 100%. And they don't know the advantages of investing in it. When you invest those HSA dollars, that money, it grows tax free. And so just like your traditional 401k plans, the money grows tax free. When you go, again, like you've mentioned, when you go to utilize it, it comes out tax free. So a number of tax advantages. But definitely look at a way to put your money to work for you.
Definitely. And you can use those monies. This is the next benefit after the age of 65 for any reason without penalty.
Yep.
Right. So it essentially is kind of like a traditional IRA in that sense.
Yep.
So if you were to take monies at 66 out for your retirement, you'd have to pay taxes on it.
Mm-hmm.
But it would be like an IRA, right? You got the deduction in the year you contributed.
Yep.
You would just pay taxes at that point in time. Now, I believe it may be more sound strategy is to use those monies for health expenses in retirement because you won't have to pay the income taxes.
Yep.
But again, if that was the only account that you had money in, or for whatever reason, your monies were locked up or it just didn't make sense to touch other monies, you could look at the HSA to use for any reason after the age of 65, very similar to an IRA.
Yep.
Right?
Yep. Absolutely. It's honestly, it's a way to even diversify your retirement portfolio even further. Because again, there are contribution limits each year, but these are completely separate than an IRA, than a 401k. So there's a number of different ways to set yourself up for future success through tax-free dollars, tax-free contributions.
Definitely. And again, just something unfortunately that's not known. And I think this can maybe get mixed up with the FSA. A lot of these can, but key differentiating points from FSA, the FSA has to be used within the year.
Yep.
So it's a little bit different. There might be some extensions you can get sometimes, but it's rare, right?
Yep.
The HSA is portable. It's can be used as a retirement account down the road. So in a lot of ways, it's kind of the alpha in comparison to the FSA. But sometimes people get those two confused. Now, the last benefit, and this is something that I found just in my research probably a couple of years ago that surprised me. I didn't know it at the time. There's kind of a loophole that exists with HSAs where you can keep the receipts of your health expenses, maybe within, let's say, the year that you have the health expense. So let's say it's this year and I go play my basketball game tonight. I don't want to speak this into existence, but let's say something bad happens. I get undercut and I break my arm and it's a $20,000 surgery or something like that.
Yep.
I really am a little nervous now saying this out loud.
But
let's just say I shouldn't use myself for the
wood.
hypothetical here, but we'll run with it.
Yeah.
I could still run with it because I broke my arm and I break my leg. So let's say that happens. That would be, some $20,000 expense.
Mm-hmm.
So I could keep the receipt from this year, but keep my money in the HSA, let it continue to grow, and then at some point in the future, reimburse myself.
Yep.
So, let's say you had an expense at 50 and you had the money to pay for that expense just in cash.
Yep.
You said, well, I don't want to take money on my HSA because this is a triple tax savings account. I like to let that money keep growing tax advantage. So you pay for it out of your checking savings account.
Yep.
You keep it in the HSA. You can reimburse yourself at a later point in time, just if you have the receipt on hand, right? So you could pull that, in this case, $20,000 out, and you would have benefited from having the growth over those years if the market went up over a long period of time. Another assumption we got to throw in there. But again, that's a loophole I don't think really anybody knows about, right?
Yeah, no, it really is. Now, as you mentioned multiple times, the key is holding on to that receipt and making sure you can track that down, because if you're audited by the IRS, you don't want to pay that penalty on there.
Exactly.
I always tell people, keep your receipts in a shoebox, keep them on a hard drive somewhere if you're moving to the digital age, which most people are. Now, with regards to receipts, an explanation of benefits that you get from your insurance carrier can serve as a qualified receipt for HSA audit purposes.
Important note. Okay.
Yeah. As long as you hold on to that EOB, or if you have access to, your insurance company's online portal, that can serve as your receipt, for air quotes there, for lack of a better word.
Helpful to know.
Yeah. So, but yeah, that's a tremendous benefit that little people know about. And one other loophole that I like pointing out is, if you have adult age dependents that are maybe still covered under your medical plan, but they're not claimed on your taxes, you cannot utilize HSA funds for their medical expenses. However, they can open up their own HSA account, and they can actually defer to the family limit on that, to that HSA account. So with an HSA, it doesn't just have to be them. You can make contributions to that account. Anyone can make contributions to that account. So for parents out there that maybe have college age kids that, or claim themselves as on their own taxes, maybe they have jobs, but you're still covering them from a medical perspective, you can open up an HSA account for them, give them a Christmas present of, $3,000-$4,000 towards their HSA.
Like a 529 in some cases. Yeah. Very similar, comparable. Yeah. That's a great point.
Yeah.
Definitely a great point. Well, thanks for that bonus benefit. That's why we have you on here. That's why we're psyched to have you back.
Like I said, I could talk HSAs for a while.
All day.
Yeah.
All day. Cool. Well, I'm a little nervous about my basketball game tonight, but hopefully everybody found this helpful. Again, I think the HSA is one of the most overlooked benefits that there is. Thank you, Kevin, for joining us. My name is Michael MacKelvie. Again, I'm a certified financial planner with Mariner Wealth Advisors. This is Your Life Simplified. If you're listening on Apple, Spotify, YouTube, make sure to hit that subscribe button to get more industry insights from industry professionals here at Mariner Wealth Advisors. You guys take care.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Because the administration of an HSA is a taxpayer responsibility, you are strongly encouraged to consult your tax advisor before opening an HSA. You are encouraged to review information available from the Internal Revenue Service, also IRS, for taxpayers, which can be found on the IRS website at irs.gov. Investing involves risk of loss, including loss of principal, that clients should be prepared to bear. Past performance is not indicative of future results. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP, registered trademark, certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.